All right, let's talk about insurance stocks. If you're an investor, you've probably realized this sector is, well, it's a whole different beast. It doesn't play by the same rules as other companies. So today, we're going to crack the code. Let's get right into it. So here's the big question, right? How on earth do you value a business that sells promises? I mean, think about it. Most companies sell you a thing, a phone, a car, whatever. You get it, you pay for it, done. But insurance? They're selling you a promise that they'll be there for you if something bad happens down the road. And because of that, our usual toolkit for analyzing stocks, it just doesn't work here. We need something special. Let's break it down. You've got your product business on one side, super straightforward. They sell stuff, revenue is clear. Then you have the promise business, selling future protection. Their entire financial picture is built around long-term risk. It's this core difference that means we can't just glance at a P&L statement. We've got to learn their language, the specific metrics they use. Okay, so first up, life insurance. Now this is the long game. We're talking about managing risks over decades. This isn't a sprint, it is absolutely a financial marathon. And the numbers we look at, they're all about that long-term view. So the first metric you absolutely need to know is something called the value of new business, or VNB for short. What is it? In simple terms, it's a snapshot of how profitable the new policies they just sold this year are expected to be. It's like a crystal ball showing the future profits from today's sales.
Now here's a super important catch with VNB, and you got to remember this. It's fantastic for seeing how one single company is doing year over year. Is their new business getting more profitable? Great, but, and this is a big but, trying to compare the VNB of company A to company B is really tricky. Why? Because they all use their own secret sauce, different assumptions about the future. So it's not an apples-to-apples comparison. It's a great internal report card, but not so great for comparing against the competition.
All right, next up, we have the persistency ratio. Honestly, you can just think of this as the insurer's customer loyalty score. It's super simple. What percentage of customers are still around after a year or 5 years? It tells you if people are sticking with them for the long haul.
And why do we care so much about this? Because a high persistency is pure gold for an insurance company. It means a steady, predictable flow of cash from renewal premiums. It's way cheaper and more profitable to keep a customer than to find a new one. So if you see a company with a strong persistency ratio, you know they've built a really solid, stable business.
Okay, let's switch gears completely. We've talked about the marathon of life insurance. Now let's talk about the sprint. General insurance. This is your car insurance, your health insurance, stuff that's usually on a one-year cycle. Here, the game is all about short-term, annual profitability. Look, if you take away only one thing about general insurance, let it be this, the combined ratio. This is the number. It's the single most important metric for figuring out if they're actually making money from their core business of, well, insuring things. And the formula? It couldn't be simpler. You just take the loss ratio, that's the money they pay out in claims, and you add the expense ratio. That's what it costs to run the show. Salaries, marketing, all that. That's it. Loss plus expenses. Easy.
So here's the magic number you need to burn into your brain, 100%. If the combined ratio is below 100, say 95%, that means for every $100 they took in, they only spent 95. That's a profit. But if it's above 100, like 105%, well, that means for every $100 they collected, they spent 105. And that, my friends, is an underwriting loss.
Okay, so we've got our marathon metrics for life and our sprint metric for general. But now let's talk about two ratios that matter for every single insurer, no exceptions. These are the ultimate health checks. They tell you if the company is stable and if you can actually trust them. The first one is a number, 150%. This isn't a suggestion, it's the bare minimum solvency ratio required by the regulator. Think of it as a hard line in the sand. If they dip below this, they are in serious trouble. So, what exactly is this solvency ratio? It's basically the ultimate financial stress test. It asks a simple, brutal question. If everything went wrong at once, does this company have enough cash on hand to pay out every single claim? It is the absolute bedrock of their financial strength. Here's how it works. An insurer needs enough money to cover all its liabilities. That's the base level. Then the regulator says, nope, not enough. You need another 50% on top of that as a safety buffer. That gets you to the 150% minimum. But the really good companies, they don't just sit at 150. They have an extra surplus on top of that, just in case. Okay, our second universal metric is the claims settlement ratio, and this one gets right to the heart of the matter. It answers the one question every customer has. When I need them, will they actually pay up? It's a direct, powerful measure of how trustworthy a company really is.
Now, it seems obvious, right? A higher number is always better. A 99% settlement ratio has to be better than a 95% one. But is it really that simple? As an investor, you've got to dig a little deeper.
And the answer is not really. Context is everything here. Think about it. Successfully paying out 95% of 1,000,000 claims is a whole different ballgame than paying out 97% of just 1,000 claims. A massive volume proves the company has the systems, the experience, and the infrastructure to handle business at scale. Sometimes a slightly lower percentage on a huge number of claims is actually a sign of a stronger, more seasoned company.
All right, that was a lot to cover. So let's wrap this all up into a simple checklist. Your go-to guide for when you're sizing up an insurance stock.
So here it is, your cheat sheet. For life insurance, the marathon runners, you're looking at VNB and persistency. For general insurance, the sprinters, it's all about that combined ratio. And for any insurer, your non-negotiables, your fundamental checks, are the solvency ratio and the claim settlement ratio. Get those right, and you're well on your way.
So there you have it. You now have the toolkit to see past all the slick advertising and really dig into what makes an insurance company tick. You can analyze the real strength behind their promises, which leaves you, the investor, with the most important question of all. Which of these promises are actually built to last?